We're talking with Tim. Tim, you're with Allworth Money Matters.
Hey, thanks for taking my call.
Yeah.
So I'm retired and I use the bucket strategy. So I have 2 years in cash, 5 years in an intermediate core bond fund, and the remaining stuff is in equities. And I try to replenish my cash and bond bucket every 4 months, depending on how the market is doing. And my plan is during a down market, only spend the cash until a recovery. So if I run out of cash, then I'll start spending out of the bonds and hopefully everything comes back. Like in 2022, the stocks took a couple of years and the bonds took 3.5. So my question is this approach valid? And what do you think of the bucket sizes?
How much do you have in equities?
Yeah, the percentage.
You're using years, which is a form of percentages.
But I don't know how much he's was spending relative to his...
Which is what would drive the decision
Right.
making. So how many years do you actually have in equities, in what you call that bucket?
So it's about 67%.
Okay.
And what percent of on an annual basis are you withdrawing from your overall portfolio?
It's transitioning because I'm moving into starting to use my pensions and my Social Security. Right now, it's a little bit above 4, but it'll go, after I start taking everything, it'll go below 4.
Okay.
And
So you're very comfortable.
And do you try to keep this 67% equities pretty constant?
Actually, I tried to keep the cash and the bond constant.
So the fact that you're
it's,
you're planning on taking a lower distribution going forward, is that then equating that you'll have a higher allocation to equities in the future?
Actually, yes, it would.
That's right.
In the future.
Mathematically, right? That's
right. That's right. You know what? So we don't use the bucket concept. We look at
sort of, but we sort of do.
But kind of. We just but we're not worrying so much about how many years we have in cash or intermediate bond. We worry about the overall allocation between fixed income and equity.
Yes, but
it does essentially the same thing.
Correct. I mean, if we never worried about distributions, you would have everything in equities.
Yes.
So if no one ever wanted to spend their money, you would have everything in equities. Long term, it's going to outperform everything.
Which we do for some.
And for some, we have no equities.
That's correct.
I mean, it depends on. So
your question is, again, what?
Is the approach valid? Is my bucket sizes about right? And I had another question after that.
Okay, it can be. It can be depending upon.
How old are you, Tim?
I am 62.
Okay.
Yeah, okay. It depends on your risk tolerance, because if, let's say, you get down to a 2% distribution, right? Then all of a sudden your equity position is going to move up to 75 or 80%, and you're
more.
Yeah, or more.
And are you calculating your interest and dividends on replenishing? So when you calculate your bucket strategy, are you just saying, here's how much money I'm going to withdraw over the next 7 years? Or are you saying, here's how much income my portfolio is going to produce?
No, how much I'm going to withdraw.
Yeah, so to Pat's point, if you move down to 2%,
yeah, you could be.
Because your equities are going to spin off almost 2% and just a...
Yeah, and dividends. And therefore, you're going to actually see your portfolio get super aggressive. It's going to be, heck, we could do the math, but my guess is going to be 80% plus, which is fine. If you could stomach the volatility. So
and the volatility could be multiple years, right?
And my approach on stomaching the volatility was, okay, if I know I have a 2-year cash bucket, then and the 5-year bonds, then when I was tracking the various dips, it seems like things kind of recover, in 7-ish years or so.
Sometimes. I mean, if you go back to other historical times, there's been times that have been much longer than that. But yeah.
Yeah,
95% of the time, that would be correct.
Look, I'm okay. I don't think that you should let this portfolio just run like this, though, on the buckets.
Because what you just told us is that you're going to take out less income going forward because you're going to start having pension and I don't know about Social Security, but having some other income coming in. So that would, by its nature, cause you to increase your equity allocation. And so the question I think we would have, does it make sense at this stage for a 62-year-old to increase the equity allocation beyond 60? And maybe it does.
Well, yeah, so let's live with this bucket strategy, but put a cap on your equity exposure as a percentage of the portfolio.
I think that's probably not a bad idea.
Right?
Here's what I like, by the way. Here's what I like about this. You have a strategy. You have a workable strategy. And if you live by this strategy, I think it'll serve you well. We are our biggest enemies when it comes to investment returns, not the markets. It's ourselves. So the challenge is if we've got this strategy, the market tanks, we get nervous, we start tweaking with our strategy, we forget our investment approach, we start doing new things. That's where problems happen. If you actually say, I'm going to live by this strategy, I think it'll serve you fine.
But I don't... did you read Ray Lucia's book? Is this where you got the buckets of money strategy from?
I got this strategy from my mother.
Oh, okay. Because there's a book that this guy wrote.
There's some. I mean, strategy's been around a long time.
Yeah, it's been around a long time. But this is all buckets of money. Although he uses annuities in there because it's probably best for him. I think I would. I'm okay if you that, but I would cap my equity exposure probably at 75%.
Okay.
Right. So you could call it whatever you want,
and I might want to match my maturities in my fixed income portfolio to when the needs are going to be.
With individual bonds
or different types of funds.
Yes.
Nope. I understand what you're. I did have a slightly related question. Is that like in a down market? Like 2022, it's easy to say, okay, I'm not touching, I'm letting my cash just draw down. And at some point when the stock started to come back, do you wait for it to reach its previous all-time high? Do you say, okay, well, it's within, 5 or 4% of its all-time high. I can go ahead and sell it again. Do you have any thoughts on that?
So our approach, and here's why we don't use the buckets of money approach. So our approach is determining how much we want to, let's just call it risk assets, equities, maybe some other private investments depending on portfolio size. Let's call it growth assets, risk assets, growth assets, right? So part of it is determining how much we want in those assets, and that's predicated upon, one, what someone's needs are, income needs are, cash flow needs, or when they need the capital. And then the second is how much risk tolerance, how much someone can stomach before they make stupid mistakes, right? So then when we come up with, and let's say it's 67%, like you've got, the way we tend to look at things is when the markets have great years, that 67% starts creeping up to 68, 69, 70, 71%. So we rebalance, we sell. By just that nature, it forces us to sell when things are high to replenish the fixed income portion. Conversely, when the markets fall from 67 to 65 to 60%, we rebalance, meaning we buy back more equities when things are down, just by the nature of keeping that asset allocation. And if you look at volatile years, particularly you look at like the year, say 2000, when we had that really quick downturn because of the lockdowns, we rebalanced, I think, 3 or 4 times. And the rebalancing in and of itself produced, I forget what the excess return was.
It was incredible.
But yeah.
It was fast. And the reason is because it forces you, the percentage strategy forces you to actually sell when the markets are up and buy when the markets are low, which the bucket strategy doesn't. Right? So if you were my client, I would implore you to abandon the bucket strategy.
Well, the bucket strategy, how often
He said every 4 months.
Okay, so it's every 4 months you look at it.
But then he asked the question that actually said, well, if the markets are down, when do I wait to actually start selling to move money back out of the buckets? And we're saying it's a constant. You should be moving. You never showed us a direction where you move from the buckets to the equities. You only showed us a direction where you move from equities to the fixed income.
Right.
So
That is correct.
And what we're saying is, look, there are times where you actually want to move from that fixed income into equities. So you're not taking advantage of the downturns in the markets in order to amplify your returns over time.
Although we've had the last almost 3 years have been straight up, so it's
it hasn't mattered, but it does matter
It
when
does
your
matter.
example
Oh,
at the beginning of the beginning
or 22, same
yes,
thing.
Yes, because these things happen, and by the fact that you're doing it every 4 months, you have the ability to do it on a weekly basis. Is the money inside IRAs or outside IRAs?
Both.
Okay. Well, then
Yes.
that's you might want to, in a perfect world, you'd have all your growth assets outside of the IRAs and all your bond inside the IRAs because capital gains rates are actually lower than ordinary income. And so you put
Focus
those,
on the after-tax return, not only in 2025, but after-tax return for the next decade or two.
So the idea that you have right now doesn't allow you to go from buckets to equities, right? From the fixed income to the equities. And I would, quite frankly, you're missing out on return and you're missing out on after-tax return because of the portfolios, if they're not designed correctly, which is the equities outside, the fixed income inside the IRAs to whatever extent necessary, you're just going to get an excess return after tax by doing that. So you're asking us to make a comment on a strategy that we would not employ because of the restrictions.
Yeah, that's fair.
The restrictions that you have placed on yourself, which, by the way, your mother may have been a wonderful lady, right? She might have been the greatest person in the world, but she may not have been the best investor. My mother was a wonderful lady. She's absolutely wonderful, the nicest lady, most caring lady. But I would never take investment advice from my mom.
I understand.
Right.
Okay.
So,
all right, Tim.
Hey, thanks for taking the call.
All right.
Wish
take
you
care.
well. It's interesting. And I almost said there's lots of there's different ways you can approach things, but obviously we think our way is the superior way. I mean, we have a fiduciary responsibility to our clients where this is.
Well, he's putting artificial restrictions on his portfolio that don't need to exist with that strategy.
Yeah, and sometimes I think I think a lot of people like doing things themselves, right? I think a lot of people take pride in the fact that they can do everything themselves. They don't need help. I do my own yard. I do whatever. I cut my own firewood. I split the wood. I paint the house. I fix the plumbing. Even people that can afford.
Which was like your stepdad.
I did it with him last night. He was telling me how he just cut some firewood.
The one that lived down in the Bay Area. The guy that had all the property with all the old stuff laying around the property in case he needed it.
Oh, my previous father-in-law.
Oh, that was it. Yes. Would do everything himself.
Everything. Made his own bolts. Literally made his own bolts. We had some bolt machine in his basement.
Wow. Okay, keep going. But
he mocked me because I remember I had my shoes polished somewhere, and he mocked me for spending my money to have my shoes polished.
Pretty sure it was your money, though.
Fair. And I was always the mindset, I'm going to focus on what I'm pretty good at, and I'm going to contract. So my point here is, I think it's the same thing happens with our financial management, our financial planning, our money management. I think it's, look, I can just do this myself. I'm just going to figure it out. And there's a small percentage of the population I think can do just fine alone. The longer I'm in this industry, the more I think people benefit from a good advisor with the right kind of tax planning along with it.
But again,
it's going to pay for itself.
It's hard finding a good advisor.
Yeah, so I think it's Pat, I think it's a combination of one, there's particularly certain people that take pride in doing things themselves. That's how they were raised. That's how they've gone their whole life. And in addition to that, it's how do you find a really good advisor, and how do you really know if it's a good advisor?
It's difficult
until you've spent some time working with that advisor.